Welcome back to the deep dive. And I have to be honest with you, looking out the window right now, deep dive feels a little too literal.
Yeah. I could,
I feel like I'm about to be submerged in a snowdrift. I really hope you're somewhere warm because it feels a bit like the end of the world out here.
it's certainly biblical. I was actually reviewing our notes for today, and I thought we really need to start with a bit of literary theory.
Okay.
Are you familiar with the concept of the pathetic fallacy?
That sounds like something I would have been accused of in high school. But no, that's the literary device, right? Where the weather, it matches the mood of the character.
That's the one. It's, Dickens and Bleak House. The fog in London is so thick it's choking people,
Right.
which perfectly mirrors the murky, suffocating legal system he's writing about. The environment isn't just background, it's a metaphor.
Okay, so if we apply the pathetic fallacy to today, January 26, 2026,
Mm.
the world is in a very, very bad mood.
And that's putting it mildly. I mean, we are in a total whiteout. The Hudson River is frozen solid.
I saw that.
The wind chill is negative 18 Celsius. That's what, below zero for the Fahrenheit holdouts. And honestly, the news cycle is trying its best to match the temperature.
It really is. It's got this distinct horror show vibe. Did you see that new movie, Sinners?
I did.
That-
Terrifying.
Yeah. Walking to the studio today felt a little like the opening scene, and then you open your phone and it's just escalating.
Escalating is the word.
We have a crisis in Minneapolis that looks like it might actually shut down the federal government over ice. Then President Trump is threatening 100% tariffs on Canada.
On Canada, our polite neighbors to the north, and maybe most alarmingly, this massive rupture in the North Atlantic Alliance in NATO just over the last week.
Right. So if you just doom scrolled the news and looked out the window, the logical conclusion is bunker time.
Yeah, head underground.
You'd assume the financial markets are crashing. You'd expect people to be selling everything that isn't, canned food and shotgun shells.
And that is the central puzzle of today's deep dive. Because if you look at the data, that is not what is happening.
It's the exact opposite. It's wild. The markets are heating up. It's like Wall Street is at a beach party while the rest of us are in a blizzard. So the mission today is to unpack this massive disconnect. Why is the market ignoring all the gloom and predicting a cyclical upturn? Are they delusional, or do they know something we don't?
Well, we have to nuance that immediately.
Yeah.
Because not all of the market is partying.
Okay.
There are some very specific corners that are just screaming, panic.
Okay, let's start with the panic, because that feels more aligned with my frozen toes right now. The fear indicators.
Right.
Some of these numbers in the research look like typos.
They certainly look like errors, but they aren't. If you look at precious metals, they're acting exactly how you would expect during a crisis. Gold is trading over $5,000 an ounce.
5,000. I remember when 2,000 felt like this huge psychological barrier we'd never cross. That is a massive amount of fear money.
And silver is over $100 an ounce.
So the shiny stuff theory holds up. When people get scared, they buy hard assets.
Precisely. A rally in gold and silver is the traditional hedge against chaos. It's the market saying, I do not trust the fiat system right now.
Okay.
But there is another fear indicator flashing red that's actually much more dangerous to the plumbing of the system,
And that is?
the Japanese yen.
Right. Japan. We've seen some serious drama there recently.
We have. Sonai Takaichi is effectively threatening intervention to strengthen the yen. And we are seeing an ominous turnaround. The currency is moving sharply.
Now, I know for most people listening, currency fluctuations sounds like a cure for insomnia.
Yay.
But you have to understand the carry trade, don't you?
You do. Let's break that down. Because the carry trade has been the engine room for so much liquidity over the last couple of years.
So how does it actually work? Mechanically.
In simple terms, think of it as free money arbitrage. Investors borrow money in a currency that has super low interest rates, like the yen, for years. Japan basically paid you to borrow money. So big institutions take that borrowed yen, they convert it to dollars, and invest it in things that pay higher returns.
Like U.S. Treasury bonds or stocks. So you're borrowing at near zero in Tokyo and earning, say, 5% in New York.
Exactly, it's leverage. And it works beautifully and generates massive profits until the currency you borrowed gets stronger.
Because now you have to pay back the loan in yen, but each yen is more expensive to buy back.
Right. If the yen spikes, your cheap loan suddenly becomes a very expensive debt.
Yeah.
And here's the danger. If everyone tries to unwind that trade at the same time,
A stampede for the exit.
It causes a massive liquidity shock. It's like everyone in a crowded theater trying to run through a single exit door.
Okay, so to recap the doom side of the ledger,
Yeah.
we have gold screaming apocalypse now, and the yen threatened to blow up the global credit plumbing.
Correct. That is the storm front.
But, and this is where I get confused, if you look at equities, the stock market, they don't seem to care.
No, they don't. They are completely ignoring the blizzard. The equity markets are betting on a massive cyclical rebound.
A rebound in this economy. With tariffs and NATO breaking down, what could possibly be fueling that?
Two main things: fiscal policy and liquidity.
Basically, government spending.
Lots of it.
Yeah.
And it's not just the U.S. anymore. Germany, Japan. They're all pushing fiscal policies that provide the juice for economic growth.
There's just abundant cash in the system.
And when you have that much liquidity, it has to go somewhere. It burns a hole in the market's pocket.
And looking at the charts, it seems like it's going into the real economy stocks, not just the big tech giants we've spent the last decade obsessing over.
That's the key observation. We are seeing a classic signal of an economic recovery. Smaller companies are outperforming the large caps.
Hold on, why is that a signal? Why does small beating large matter? I usually think of the big guys, Apple, Google, as the safe bets.
They're safe, but they are insulated. Small companies are much more sensitive to the actual physical economy. They don't have the massive cash piles to weather a storm. So if investors are buying small caps, they are betting that the actual gears of the economy, manufacturing, regional banking are going to turn faster.
It's a vote of confidence in Main Street, not just Silicon Valley.
Precisely. And alongside that, we're seeing a big shift from growth to value.
Okay, let's define those quickly because those terms get thrown around a lot.
Sure. Growth stocks are companies where you are paying for future potential. Think AI startups, tech giants. You pay a premium now for earnings way down the road.
Right.
Value stocks are companies that are trading for less than they are, essentially worth right now. Think boring stuff. Banks, heavy industry, energy, they're cheap relative to their earnings.
And for a long, long time, growth was the only game in town.
It was painful. If you bought value, you lost money. But now, value is suddenly winning.
Why?
The psychological reason's fascinating. Investors perceive that growth is now abundant, thanks to all that government spending. If growth is everywhere, why pay a huge premium for a tech stock? On the other hand, finding good, value, solid companies at cheap prices, that's getting harder. So money is flowing there.
But here's the part that surprised me the most. Usually when we talk about a booming stock market, we mean the S&P 500. We mean America. But the U.S. is actually lagging.
It is startling. The rest of the world is outperforming the U.S.
That feels backwards. Usually in a crisis, money floods into the U.S. for safety.
Not right now. In Europe, Australasia, and the Far East, what we call the EAAA, markets investors are buying value stocks so aggressively that they're generating momentum.
Wait, combine those two for me. Value and momentum. Aren't those usually opposites? Value is the tortoise, momentum is the hare.
Exactly. That's the paradox. Usually you buy value and wait for years. Momentum is for the high flyers. But right now, outside the U.S., they're overlapping. The cheap stocks are rising so fast they are becoming the hot stocks.
A whale of a time for global markets.
It is. But in the U.S., value is still languishing.
Why? Is there a political angle? I mean, we have President Trump back in office.
Paradoxically, yes. The return of Trump seems to have catalyzed a search for value outside the U.S.
But you'd think America first would mean American stocks first.
You would think. But investors are looking at potential tariffs, potential inflation in the U.S., and deciding the better deal is abroad. They're pricing in the risk of U.S. isolationism.
So they see the U.S. as expensive and volatile, while Europe and Asia look like bargains.
That's the bet they're making, even in emerging markets.
Really? Because usually when the U.S. sneezes, emerging markets catch pneumonia.
Even there. If you exclude China, which is its own special case because of the power competition, EM is outperforming. And here's the kicker. Even nations hit by high U.S. tariffs are seeing a surge in confidence.
That makes no sense. If Trump slaps a tariff on a country, their stock market should tank.
In a textbook, yes. But in reality, investors are looking at the fundamentals. Even with a tariff, if a company's trading at a rock-bottom price and making good profits, it's still a buy.
The profits are stronger than the tariff fear.
The fundamentals say boom, even if the politics say trade war. The market is effectively saying, we don't care about the politicians, we care about the profits.
Speaking of fundamentals, we can't talk about a global industrial boom without checking in with the doctor.
Ah, yes, Dr. Copper.
The metal with a PhD in economics.
That's the nickname. Because copper is used in literally everything: construction, electronics, power grids. Its price is usually the best predictor of global economic health.
So, what is the doctor's diagnosis right now?
The doctor is hyperventilating. Copper prices are up nearly 50% in just 8 months.
50%. In less than a year? That's not normal volatility.
Since Liberation Day, which is what some analysts are calling this shift, it has been a vertical lineup. Now, usually we'd say, okay, the global economy is strong, but this time, it's not just general growth.
It's specific, desperate demand.
Exactly.
What are we building that needs so much copper? I thought the future was silicon, not copper wiring.
That's a common misconception. The wireless world requires a massive amount of wires to work. And you have two huge drivers: AI and the green transition.
Data centers.
Massive ones. We talk about AI as software, but AI lives in a physical data centers that consume immense amounts of power. To move that power, you need copper.
You can't code your way out of physics.
You can't. But it's also the grids themselves. Remember that winter storm in Dallas a few years back? The grid failed completely.
Yeah, people were burning furniture to stay warm.
That showed the world our grids are fragile. We need to upgrade them to handle extreme weather. That upgrade takes millions of tons of copper.
So that's the demand side. Let me guess, the supply side is a mess.
It's a disaster. And this is the part people forget about mining. It is inelastic. You can't just turn on a copper mine like a light switch.
Right.
It takes years, maybe a decade, to permit and dig a new mine. And we've had years of chronic underinvestment.
Because copper was cheap, nobody dug new holes.
Exactly. Wall Street told them not to spend. So they didn't. And the mines we do have are facing trouble. Panama, Indonesia. Major sources are having problems.
I read something in the notes about unencumbered inventories. Can you translate that for us?
It basically means the pile of copper sitting in warehouses, London, Shanghai, that is actually available to buy right now.
And?
It is at unprecedented lows. The cupboards are bare.
So, high demand, zero new supply, and empty warehouses.
Louis Vincent Gave and Daniel Gali, two experts we looked at, argue that the market can no longer withstand disruption. They're using phrases like melt-up.
A melt-up? That sounds violent.
It implies prices overheating rapidly. Unless the entire AI narrative collapses overnight, copper prices are going higher.
Which implies that copper miners, the companies digging the stuff up, are about to make a fortune.
They're poised for huge cash flows and higher valuations. It's a classic resource squeeze. Economics 101.
So let's look at the board. We have the pathetic fallacy weather, a geopolitical mess, a booming stock market, a desperate copper shortage. But we have to talk about the elephant in the room, the Fed.
The Federal Reserve. The political backdrop to all of this?
There's a meeting coming up, isn't there?
There's an FOMC meeting this week, but honestly, it's likely to be the boring one. The expectation is that nothing happens.
Okay.
The real drama isn't about what happens this week, but who comes next.
Right, the new chair, the nomination for who takes over in May.
And the betting markets have shifted wildly. It used to be a race between, as one analyst put it, a couple of guys named Kevin.
I love that. Just pick a Kevin, any Kevin.
But now, the clear favorite is Rick Ryder from BlackRock.
BlackRock. That's a heavy hitter, as establishment as it gets.
It is. But here's the unique part. If he gets the job, he would be the only candidate who hasn't previously worked at the Fed.
Is that a feature or a bug? I mean, you usually want the surgeon to have been in the operating room before.
In this political climate, it's probably a feature, an outsider, someone who understands markets from the investor side, not just the academic side.
But the big question is, does this mean easy money?
And the market says no. Expectations for a dovish break slashing rates are minimal.
Really?
Yeah. If you look at the betting odds for a rate cut in June, the first meeting under the new chair, they're only at 74.5%.
74% sounds high, but in Fed speak, that's not a sure thing, is it?
Not at all. The bond market, unless it's 95% or higher, it's just a maybe. It shows hesitation.
And this leads to the biggest conflict in this whole thing.
The tension at the heart of the market. Exactly. Think about it. The market is betting on a massive cyclical boom.
Right. Profits up, hopper surging, small caps rallying, boom times.
But the market is also expecting rate cuts.
And I'm guessing those two things don't usually go together.
Rarely. Why does the Fed cut rates?
Because the economy is in the toilet and needs help to stimulate borrowing.
Exactly. You cut rates to save a dying patient. You don't give adrenaline to someone running a marathon at record speed.
Right.
If we have the profit boom the market expects, the Fed has no reason to cut. In fact, if the economy heats up too much, they might need to raise rates to stop inflation.
So the market is trying to have its cake and eat it too. It wants the boom and the stimulus check.
Andrew Lapthorne from Societe Generale points this out brilliantly. He says profit growth on this scale seldom, if ever, coincides with the rate cuts. It's a contradiction.
So something has to give. Either the boom isn't real or the rate cuts aren't coming.
That is the risk. That is the cliff edge we might be walking from.
The pathetic fallacy. The world looks like a disaster zone. Snow, ice, frozen geopolitics.
But under the surface, the economic engine is roaring. Copper melting up, small caps rallying, the rest of the world waking up.
So what does this mean for you if you're sitting there, shivering, reading the scary headlines? What's the move?
The first takeaway is, don't let the headlines dictate your view of the economy. The horror show outside is not reflected in the order books of companies.
The news is not the market. Lesson number 1.
Secondly, recognize the rotation that's happening. For a decade, the advice was buy U.S. tech and go to sleep. That's changing.
It's a big shift.
The action is moving to real stuff. Commodities like copper, industrial small caps, and it's moving internationally. Europe, Japan, emerging markets. That's where the momentum is.
It's almost a return to the physical world, real metals, real manufacturing.
It is. We're looking at hard assets again. A pivot to tangibility.
And finally, let's leave everyone with that provocative thought you mentioned, that central tension.
Yes. The market is currently betting on two contradictory things. A massive economic party and the emergency medicine of rate cuts.
Can we really have both?
Or is one of those assumptions about to hit a brick wall?
That is the multi-trillion-dollar question. If the boom is real, rates might stay high. If rates fall, it might be because the boom was a mirage.
And in this weather, you don't want to be caught out in the cold on either side of that bet.
Absolutely not. Well, that wraps up our deep dive into the freezing cold, red-hot market of 2026. Stay warm out there, everyone.
And keep an eye on Dr. Copper.
We'll see you next time.